Welcome to this guide on risk classifications and evaluating investment securities. Understanding the risks associated with various investment options is crucial for making informed financial decisions. Let's begin by exploring different risk classifications. Bonds are generally considered less risky investments because they pay a stated interest rate that issuers are obligated to meet on a regular schedule. However, they are not risk-free. Investors must be aware of several types of risks. Credit default risk, the risk that the bond issuer may fail to make interest or principal payments. Interest rate risk, the possibility of bond prices falling when interest rates rise. Inflation risk, the potential erosion of purchasing power due to inflation. Liquidity risk, the challenge of selling a bond at a fair market price. Call risk, the risk that an issuer might repay a bond before its maturity, potentially affecting expected returns. Bonds are further classified based on credit ratings. Investment-grade bonds, rated BBB or higher by Standard & Poor's or Ba3 or higher by Moody's. Non-investment grade bonds are known as junk bonds, rated below BBB or Ba3. These offer higher interest rates to compensate for increased risk. Bonds also vary in terms of maturity classifications. Short-term bonds mature in less than 4 years. Mid-term bonds mature between 4 and 10 years. Long-term bonds mature in more than 10 years, typically offering higher interest rates to account for longer repayment delays. Now, let's turn our attention to stocks. Stocks carry more risk than bonds because stockholders are the last to be repaid in the event of bankruptcy. Several risks are associated with stock investments. Business risk, risks stemming from a company's operations or market conditions. Volatility risk, price fluctuations due to internal or external factors. Beta measurement, a stock's volatility relative to the overall market, where beta greater than 1 indicates higher volatility than the market. Beta less than 1 suggests lower volatility than the market. Stocks are also classified based on market capitalization. Large cap, over $5 billion, e.g., Apple, Amazon. Generally stable with consistent dividend payments. Mid cap, between $1 billion and $5 billion, e.g., La-Z-Boy, Fitbit. Offers growth potential but carries more risk than large cap stocks. Small cap, less than $1 billion, e.g., Valmy Resources. Often in early growth stages, making them more volatile and riskier. Tax treatment. Tax considerations play a significant role in investment returns. Capital gains tax, long-term gains are taxed at lower rates than regular income. Government bonds, often exempt from federal and state taxes. Municipal bonds, generally free from federal taxes and, in some cases, state taxes. Retirement plan tax advantages. Stocks held in retirement plans benefit from tax deferral on capital gains and dividends. However, distributions from these plans are taxed as income. Investors must also account for various investment expenses. Stock transaction fees. Fees range from $5 to $20 per trade, but many self-service platforms eliminate them. Full-service brokers charge higher fees for professional advice. Mutual fund fees. Shareholder fees, associated with transactions. Sales loads, fees paid to brokers, including front-end loads, paid at the time of purchase. Back-end loads, charged upon selling, if holding period conditions are unmet. No-load funds, do not have sales loads but may include other fees. Annual operating expenses, management fees, pay for professional portfolio management. Distribution fees, cover marketing and sales expenses. Administrative expenses, include legal and accounting costs. Finally, retirement plan fees include plan administration fees, cover record keeping, accounting, and trustee services. Investment fees, similar to mutual fund fees, for managing portfolios. Service fees, charged for participant-specific services, such as loans. In summary, understanding the risks, classifications, tax treatments, and expenses associated with investments is essential for maximizing returns and achieving financial goals. Investors should carefully evaluate options, fees, and risks to align with their objectives.